Hi everyone. Welcome back to the chapter 7. Chapter 7, we're going to talk about long-term asset. And long-term asset, as it's defined in the name, is the asset can benefit the company for more than one reporting period. And these chapters, we're going to cover three part of the content. First, we want to cover how do you acquisite the long-term asset in terms of what is tangible asset, what is non-intangible asset. And second part, we're going to talk about how to cost allocate those assets into every reporting period. We kind of mentioned that a little bit before in chapter 3. We talk about accumulated depreciation. And then I understand that majority of us have a hard time to understand why is the control asset account, where they come from. And this chapter, we are going to elaborate on it. And you will understand why there's that account and what is the relationship between accumulated depreciation and long-term asset, and what is the depreciation expenses. And then third part of it, of course, we're going to talk about how to retire a long-term asset in terms of whether there is a trade-in of new asset, or there's a disposition, or there's a retirement of the asset, or in exchange of something new, and how do we record those transactions. Okay, so without further ado, I will share my screen, and then we're going to talk about part A right now. And I do not think this chapter has a lot of difficulty in terms of challenging concepts. And I believe you already probably get in the rhythm of accounting, financial accounting, if you stick along this far. And so, but what is the difficulty about this chapter is memory. So there's a lot of stuff that it's new, but it's very informative. It's actually very useful in life. So you need to memorize a lot of knowledge points. So I consider this chapter a knowledge chapter. Okay. Okay. So let's start. Okay. So let's just put it right here. Okay. So of course, long-term asset, as I mentioned a little bit earlier, it's separated into two categories in general, tangible asset and intangible asset. Tangible asset is things that we can see and touch. It has a physical existence, such as land improvement, for example, like sidewalks and buildings, right? And equipment and natural resources, such as the oil or coal mine. All those things are physical substance, and physical, we can see them. Okay. And then the intangible assets is actually something that we actually dealing with on daily basis, but didn't we really notice. First of all, patent, right? So it's an exclusive right for someone to use or produce something you created, okay? And trademarks is everywhere, right? Logos and so some kind of a brand name, right? Such as high luxury brands and trademarks. And then copyrights is essentially like authors, right? Or publications. So, or anything that it's intangible, intelligent, it's a knowledge-based and intelligence-based asset that if anybody want to sell your knowledge, then they need to get your copyrights. And then that means that whenever they publish anything that you wrote, or you produce a movie, or you creating a song, or you compose anything, so they have to pay you. Okay. Franchise is basically people you like, for example, McDonald's franchise or Dunkin' Donut franchise, or some kind of the process they wanted to reproduce exactly use your name, and then it's actually an agreement that you allow them, you will teach them how to use your intellectual assets. Okay. And for example, McDonald's franchise, the French fries has to exactly 3 minutes, and then how does the ingredient was put on the fries, and how thick that fries is, and what is defined out as a sandwich. You know, all those franchise are people actually paying McDonald's and then to have the the right to produce. Okay, and the goodwill is something that is pretty new to you guys, I believe, and to me as well when I learned in this class. It's usually happen, it's often happen in acquisition, okay? And then we're gonna talk about it in detail, and a lot of um, company nowadays has a lot of assets under the name of goodwill, okay? Especially 500 Fortune company. And in summarize, intangible asset is an asset that lack of physical substances, and its existence often based on legal contract. Okay. Okay. So and then you ask me where can I find this information in terms of balance sheet? Okay. There's a section under balance sheet is an asset section, and you will see property, plants, and equipment section. And also you will see intangible asset section. And in this example, it shows you in sum how much that is for that specific company. Okay, so now we'll talk about the acquisitions. Acquisition, we first need to identify the major types of property, plant, and equipment, which is a tangible asset. And the way we're recording the cost on the book of either property, plant, or equipment is there's a one golden rule. The golden rule is the original cost that you pay plus all the expenditures necessary to get that asset ready for use. Okay, so specifically, if you bought a land including all the cost of land and all the expenditures necessary to get the land ready for intended use. The cost for the land ready for use, including, for example, real estate commission, back property tax, or other obligations that the land was associated with, and a cleaning or filing or leveling the land, or cash received from selling the salvage building material reduce the cost of land. Okay, let's look at example. For example, you paid $500,000 including the existing buildings for a piece of land. And then you paid the real estate commission for $30,000, and you paid the property tax associated with that land for $6,000. And the title, you want to insure the title, and then therefore you pay the $3,000 insurance on the title. However, you want, for example, the land you intended to use for farming purpose, therefore you wanted to remove the existing buildings. And that remove the existing building cost you $50,000. That is also added on the cost of land. And then at the same time, you find that in order to, when you get rid of those existing buildings, there's a material such as bricks and metals, they can sell for money as well. Hence that they knock down the cost of removing for $5,000. So that will reduce your cost of land. And then after that, you need levering that land for $6,000. Hence that in order to book that piece of land that you just purchased is actually totaled at $590,000. Okay, so to illustrate the logic behind how to acquire a land and how to book on your how to recognize the cost, the land should include the initial price, which is a $500,000 plus all the expenditure net of the salvage value of the material necessary to get the land ready for your use. Okay, and then we talk about the land improvement, such as there's a lot of months that you can spend on to improve the land. For example, you want to build in a parking lot, or you want to do a sidewalks, driveway, landscaping, lighting system, and fence and sprinklers. And those land improvements usually have a limited useful life, and then therefore their useful life is uncomparable to land. Land has unlimited life, okay? So therefore this land improvement with those limited useful life has to be recorded separately from the land itself, okay? So in another word, so if you are creating a sidewalks along with the piece of land that you bought, so you were recording the sidewalks right? And then you will put the land here. You don't put the sidewalks with land together, okay? Okay. Okay, next one we talk about buildings, which is very common. Buildings such as administrative office, retail store, manufacturing, and storage warehouse. And then those things that you bought at the cost of that, say they charge you $500,000 for it. At the same time, you also need to include in the cost of getting that building ready for your own your use that you intended to use those building for. For example, realtor commission always, remodeling costs, okay? And also unique accounting issue always arise when the firm is construct a building rather than purchasing it. The difference is that if you're constructing it yourself, the mortgage that you take out for the construction loan is actually can capitalize the interest cost. What does capitalize mean? Capitalize means that the cost of the interest become a part of the building's cost, and it can park or put on the balance sheet. But if, for example, if you are buying the building from someone else and then you don't have enough money and you get a loan, and then you need to pay the interest rate, and that interest has to put as a expense, hence and showing up on income statement. Okay, so this is a big difference. Okay, so if you build your building on your own, that mortgage interest is actually can put as a part of the building itself, hence it's gonna landing on the balance sheet. Okay, equipment. So equipment is a machinery used in the manufacturing or computer, other office equipment, vehicle or furnitures, right? And the cost of equipment, as always, it need including sales tax, shipping fees, and assembling fees, and any other costs associated to prepare that asset for the usage. So there, and then, but we have to remember recurring costs such as annual property insurance or annual property tax on the vehicle are expensed as incurred. So in other words, if you bought a car for the usage of the company, but you find that you use a car and you wanted to repair it and you want to upgrading it, and uh, so for example, you wanted to paint it on the logo of your company, those things are part of acquisition cost of the equipment because you wanted to prepare it for the usage of the company. However, if you buy the car insurance for that car that used for a business purpose, then you have to expense that car insurance as expense instead of part of the cost for the car. Okay, so let's look at the cost of equipment. How do we compute the cost of equipment? So first of all, of course, you're gonna add the purchase price, and also the sales tax is also included in the part of the cost of equipment. And then the transportation fee, that shipping from where you buy it and to where you want to use it, is also part of the cost of equipment. And also when you ship, you want to ensure there's nothing goes wrong during the delivery process. That shipping insurance also including a part of the cost. And then when you got there, you wanted to also install it, and it's a complicated process, hence that the installation fee still is a part of the cost of equipment. And then in the end, park on the book, you park 91,000, including all these things. Okay, this is fees that used to set up the equipment for your intended purpose, and this is a purchase price. Okay, and so that next question that you might ask is, okay, what if I buy more than one asset at the same time? At one purchase price. For example, when you have a like bundled sale, and then if you only buy one of the whole things, then they're gonna charge like 20% more. So for example, and then but if you buy everything, it's gonna be much cheaper. So for example, you buy land, building, and equipment together for 900,000. Okay, then what? How do you separate each assets, right? Okay, because we needed to record the land, the building, and equipment in a separate accounts, then we must allocate the total purchase prices based on the relative fair value. So I wanted to introduce to you what the meaning of fair value. Fair value means what is the current value out on the market. And we talk about this in the chapter 6 about the lower cost or fair market value of the inventory, right? Same here. Fair value means how much this asset really can exchange in the market right now. How is the appraisal? How much this asset is appraised? Okay, so in another word, to allocating 900,000 to land account, to building account, and to equipment account, we need some sort of proportion, right? And this proportion is determined by the relative fair value of each part, each item that you bought. Okay, we will see example. For example, if you purchase the whole three for 900,000, and then you ask appraisal, say, hey, please appraise the land, the building, the equipment for me. And then you find out actually land the fair value is 200,000, building is actually 700,000, equipment is 100,000, and total value of fair market value is 1 million, and you only paid 900. That means you got a good deal, but at the same time, you still only you can only allocate this 900. This is what you paid, right? And then how do you allocate 900 to land, to building, to equipment? You want to use a relative fair market value of land in terms of 1 million. So in other words, that allocation percentage of land should be 200,000 out of 1 million, okay? And then multiple amount of basket purchase price of that you paid. Hence that you need only record the land for 180,000 on the book, okay? And then in terms of building, because building out of this whole fair market value bundle is a 700 dividing 1 million is about 70% of this relative fair value. And then you multiply your purchase price and you end up with 630,000 to book the building. And then the equipment, actually the fair market value is 100,000 and then out of $1 million. So that means it's only 10% of the 900,000. So therefore you book 90,000 in terms of equipment. And then in the end, this 900,000 get split into 3 accounts based on the relative fair market value. Okay, so let's do an example. A company makes a basket purchase of land, building, and equipment with the estimated fair value of each one is 700, 150, and 30,000. So that means land is 700,000, building is relative fair value is 150, and equipment is 30,000. And then the purchase price of this whole thing is 210, and how much should be recorded to the land account? Okay, so first of all, it's true to say because let's see the process. The purchase price of 210 is supposed to be allocated to separate accounts for land, building, and equipment based on their relative fair value. And the total fair value of these three assets is 250, right? Because 250,000 equals 70,000 plus 150,000 plus 30,000, right? And then out of this 250,000, the land percentage is 70,000 dividing the 250,000, and it gives us 28%. So therefore, in order to calculating the book, how much the book value of this land, we should use the purchase price, which is 210,000. So we will 210,000 multiple 28%, and it gives us 58,800. In other words, when we bundle purchase, basket purchase, we always wanted to allocate the purchase prices to individual account. And how do we do that? We needed to use the relative fair value of each purchase and how much the proportion that is based on, and then to multiply the purchase prices. Okay. Okay, and then the last tangible asset we want to talk about is actually natural resources such as oil, natural gas, and timber and salt, right? And or even coal mine. So and then it's distinguished from other assets by the fact that they are physically used up or depleted. So in other words, if you buy a equipment, naturally you look at it, it does not shrink, right? At most it's getting old, it's a slowing. Or if you buy a building hundreds of years ago, like 10 years later, the building itself is not gonna shrink or disappear. And interesting enough, the natural resources itself as a tangible asset, the distinguish between the other asset and this asset is that natural resources one day gonna dry it up. So oil can be depleted, it can dry up. Natural gas is also can be dried up. Timber, you can cut everything and then you become desert. And then hence that we needed to also record it as a cost. So in order to calculate it first, we talk about acquisition of these assets. So we need to record it, them, of course, at the cost plus all other costs necessary to get those natural resources ready for use, right? Okay. So the key point here I want to tell is tangible assets such as land, land improvement, building, equipment, natural resources are recorded at the cost plus all the costs necessary to get the asset ready for use. Okay, so this will be the big difference to the intangible asset. You will see why, okay? I will summarize a little bit later. Okay, so then let's move on to see what intangible asset there is. Okay, so first of all, intangible assets including things that not have a physical substance, but they can benefit the process of the company for longer periods, right? Hence that the intangible assets including patent, right? If you own a patent, that make money for you. And if you have a copyrights, if you are a movie distributor or produce a studio, you have a copyrights that kind of majorly become your revenue stream. And then if you have a trademark, if you have franchise, you have your goodwill. Okay, all these things are lack of physical substances, but they are actually benefit the company in future period. They are the resource of generating money, right? And then they are very valuable, right? And the existence often based on the legal contract. And then the acquire in both basically two ways. One is purchase from someone, or another one is deliver internally. Okay. So let's talk about in 2017, there's a best global brand ranking and from interbrand.com. And it's valued that the Apple is actually #1 in terms of intangible assets, brand value, right? Goodwill. This is goodwill. It's like 118 billion, okay? And then the next one is Google, Microsoft, and Coca-Cola, Amazon, Samsung, Toyota, Facebook, Mercedes-Benz, and IBM. So this is the top 100 top 500 firms who has a substantial intangible assets. Okay, in other words, if you look at the balance sheet, on the left-hand side assets, there are not much tangible assets, but there's a lot of intangible, right? So that boosting the value of the assets very high, okay? So when you're liquidating this kind of a firm, there's not much to sell, okay? So, so purchase the intangible. Okay, so let's first talk about how to recording and reporting intangible from the purchase perspective. If you purchase the intangible from someone, you will record the intangible asset at their original cost plus all the other costs necessary to get it ready to use. No difference than tangible assets. So it's almost the same as tangible assets, right? Like similarly to reporting purchase property and planned equipment. However, intangible asset that is developed internally, that's a very big difference, okay? You have to expense in the income statements most of the costs for internal development intangible assets in a period when we incur those costs. In other words, so if you are developing a patent or you are developing a trademark, so all those years of, or you are writing a book or you are making a movie, right? So all these costs that when you are developing those products or end results, it actually has to be parked on the income statement, has to be expensed. So therefore, it's very difficult, and then only specific items can be capitalized. And then so therefore, it's very difficult for people to convey what the portion of the expenses that you incur should be expensed and what portion of the expenses should be capitalized. But there's a one golden rule. If you feel like the expenses that incurred during the R&D, we call it research and development phase, can benefit future periods, then you can persuading the SEC that yes, or auditors, yes, that should be capitalized. But there's a very gray line of what you think is beneficial for future and what the auditor thinks is benefiting in future. Okay. In other words, majority of the costs incurred to develop or research intangible assets that developed internally should be expensed. Okay, so let's first of all define what is a patent. Okay, we're gonna individually talk about how many intangible assets there is. First of all, we talk about a patent. Patent is an exclusive right to manufacturing a product or to use a process. And then it's usually granted for only 20 years. And then when it's purchased, you should capitalize the purchase price plus legal and filing fees, right? So all those expenses, first the purchase price and plus anything that's incurred during the course of get ready for it to use. However, when you develop internally, you can only capitalize the filing fee and legal fees, okay? And then the whole process you're trying to develop that patent, such as research development costs, are expensed immediately in that period. Okay, copyrights. It's an exclusive right of protection given to the creator of published works, such as movies, journal, publications, authors, books. So it's granted for the life of the creator and plus 70 years. And then it's allowed the holder to pursue legal actions against anyone who attempt to infringe the copyright. So if anybody wanted to reproduce the movie that you produce or the piece of music that you wrote, and then not telling you, not paying the fee to you as a grade, or you period just didn't want them to copy and use it, so that you can actually take in legal actions against them. Okay, and this exclusive or privilege of using the copyrights of what you created is your life, right? Span of your life and plus 70 years. Therefore, a lot of people now can play Mozart and then Beethoven, those music without even asking that, because it's already past the limit of the years of protection. Okay, so accounting transaction related to copyright is virtually identical to that patent, such as if you purchase it from someone else, then you're calculating the purchase price plus the legal and filing fees related to that purchase and as a whole to park on the balance sheet. But if you develop this internally, it takes you years to write that book. Sorry, those cannot be, or it takes you years to produce that movie. You hire so many people and add, writers and then sets and stuff. All those expenses actually has to be expensed on the income statement. Okay, Trademarks is such as a word or slogan or symbol that distinctively identifies a company or product or service, so such as Louis Vuitton and such as Nike, Adidas, anything Apple. All those are the trademarks that are specifically developed by a specific company to identify themselves from other bags, other shoes, other devices. So those are the trademarks. And then they are always renewable, okay? Renewable for an indefinite number of times of a 10 years period. And then there's so therefore later on you can see their trademark can have a limited renewable life, and then the trademark can renew for forever. But every time you get a granted, you only get 10 years period. So every 10 years you need to renew it. And then, okay, so what you can capitalize and what you have to expense. Normally, you can capitalize the legal registration and design fees, okay? And advertising cost has to be expensed as incurred. So if you don't advertise in Apple or you don't advertise in Nike and Louis Vuitton, you will not become a well-known trademark. However, those advertising costs has to be expensed, cannot be capitalized being part of the deal, you know. Only the legal or registration and the design fees then can be used as the part of the cost of part of capitalize the cost for the trademarks. Okay, franchise. Franchise means the local outlets that pay for the exclusive right to use the franchisor's name to sell its products within specific geography area, such as Dunkin' Donuts, Subway, McDonald's, and all these fast food chains. They are franchisee. They actually pay for the right to use those big names and those recipes and menus to sell their products and within specific geography area, right? And the franchisee, which are the ones who actually want to buy those franchisors' name, records an initial fee as an intangible asset. For example, if it takes you 200,000 or 500,000 to open a Dunkin' Donut cafe on Ceilings Grove Market Street, and then that 500,000 is going to be your assets. Okay, called the franchises assets. It's an initial fees that you have to pay the Dunkin' Donut Corporation to set up that cafe. And additionally, that you incur periodical payment to the franchisor, such as like training fees, insurance fees, material fees, advertising fees, those things that the franchisor actually help you develop it, or marketing fees. Those additional prices payments, periodical payment to the franchisor are usually expensed as incurred. Okay, only initial fee that you set up that name and you are authorized to use their names to open a shop, that thing is capitalized. Okay, then we wanted to talk about the most expensive or most valuable assets. It's actually goodwill. Okay, goodwill is actually a portion of a purchase price. It can never be internally developed. Okay, not internally developed. It has to be purchased. So it's a part of the purchase. Goodwill is a portion of purchase price that exceeds the fair value of identifiable net asset. And it's recorded only when one company acquires another. Like I said, it cannot happen when you're developing your own goodwill, okay? Only happens, okay? And then how do we determine how much is a goodwill? First of all, we need to understand what is the net asset of the acquired company. The net asset of acquired company equals assets of that acquired company minus the liability that a company come with, okay, assume. And most of the company also created goodwill to some extent through advertising, employee training, and other efforts. However, as it does for other internally generated intangibles, a company must expense those costs incurred in the internal generation of goodwill. Okay, So in another word, the goodwill is only recognized when it's one company acquiring another. If you want to create a goodwill internally through advertising, employee, and training, it's usually you have to expense it. In another word, it cannot increase your goodwill. Let's just use a simple example to explain how do we calculating the cost of goodwill. So for example, Allied Foods acquired Reed's product for 36 million. And then the following information is known for Reed's produce. They had a fair value of the identifiable assets for 50 million and the fair value of identifiable liability for 26 million. Hence that the net equity for this company should be 26 million, right? Because the fair value of the equity should be 26 million. And how much will Ally record the acquired receipt produce goodwill? So basically, Ally buy Reed's, right? And then after this transaction, Reed's gonna become a part of Ally. But at the same time, Reed's assets, Reed's liability become a part of Ally's assets, part of Ally's liability. And then because, as we see, the fair value of the equity of the Reed's should be $26 million, but the Ally bought the Reed's for 36 million. Hence that there's a 10 million extra. Is higher than what the real equity is, right? The fair value of equity. Okay, so therefore there is a goodwill generated for 10 million for Ally Food Goods, Ally Foods, right? So purchase price of 36 million minus the fair value of assets acquired of the Reed's and the less the fair value of liability assumed of the Reed's. And then that's give us 26 million of the fair value of identifiable net assets. And I call it an equity, but you can say it's net assets. Hence that the goodwill is gonna become the $36 million that Ally paid for the Reed's during the acquisition and minus net assets of the Reed's. And then this 10 million gonna become the goodwill of Reed's, which is gonna be parked on the Ally's balance sheet because Ally become part of the owner of the Reed's. Okay. Okay. So the key points here we want to take away is intangible assets, including patent, copyright, trademarks, franchise, and goodwill. Okay, let's see the concept check. Which one following is an exclusive right to manufacturing a product or to use a process? It should be patent, right? Okay. And then it's only worth for 20 years, right? Okay. So, learning objective 7.3 is to describing how the accounting treatment of expenditure after acquisition, right? That's very important. We understand tangible assets, the cost, right, should equals the price you pay plus all expenditure paid to get it ready for use. And then intangible assets costs. If it's a if it's purchased, right? So it's also purchase price plus the all expenses spent to get it ready to use. And usually this expense, the expense we're talking about here, it should be only filing fees, right? Filing fees and lawyer fees to get it ready. However, if it's internally produced intangible asset, usually you will expense all R&D expenses right? So you will put the R&D expenses away on the income statement. You only capitalize filing fees, right? Or legal fees, right? So this is a big picture what we learned from acquisition cost. Acquisition cost. Okay, so next thing we want to talk about is the expenditure after you buy, and how do you expenditure it? Okay, so expenditure happens after acquisition, such as you're going to repair or maintenance them, or you're adding something on top of what you have, or you want to improve something, or there's a lawsuit involved. Okay, so then how do we deal with this costs? So in nutshell, okay, for all expenditures after acquisition, you want to expense if they only benefit for current period, okay? And then you can capitalize if you can persuading auditors or SEC that those costs are gonna benefit for the future period. So then you capitalize. What do I mean capitalize? It means it can be part of the asset, park on the balance sheet. Okay, so let's look at some specific example after the acquisition. So repair and maintenance. So if the maintenance is given a level of benefits in the current period, only benefit for one period, then we usually expense it. Repair and maintenance, if it's making major repairs that can increase the future benefits for more than one period time, and then we capitalize it. If you are you're adding addition. So this is a maintenance 1 and maintenance 2, right? So if it's only benefit for current period, you expense it. If it's a repair, it's a major part and it's a sustaining for more than one period, you will capitalize it. And then addition. Addition means you adding a new major component. Of course, that major component is gonna be extending on a future period, then you will capitalize it. Okay. Improvement, of course, if you improve something, you're replacing a major part of the component, it will be utilized in the future period, hence you will capitalize it as well. And then if you are legal and defense the intangible asset, it's also because you want to maintain the rights of using it for the future period, right? And then therefore you will capitalize it. However, if you only to however, if those legal battles end up with lose, so you have to expense it because you didn't really sustaining the intangible assets life, or you didn't really successfully defending the cases, and the intangible asset has to be canceled or has to be write off, and then in that case, you have to expense those legal fees. Okay, and then with that big picture talk about, then we also need to make sure that you are expensing or capitalize based on the materiality of the cost. For example, if your addition is like $100, am I gonna expense it or am I gonna capitalize it? Versus your addition is 1 million, right? So there's besides this conceptually definition of how to capitalize and how to expense it, you also need to consider the amount of that addition or repair. Okay, first of all, when an item is said to be material, it is large enough to influence a decision, okay? Second of all, when the expenditure is not material, when the things that you spend after your acquisition, then the item should be recorded as expenses regardless whether expected period of time of usage. For example, if you add a screw on the equipment, of course that screw gonna serve for future periods as long as the machine's working. But that screw is like what, $2, $5, and that regardless whether that can serve a future period of time, it's usually expensive. Okay, companies usually should generating a policy that regarding how much is being considered as a material, and then if the expense is exceeding for example, the materiality is set up 1,000, then you should be able to capitalize it. But if the expenses of all costs are under a certain dollar amount, such as like say $1,000, regardless whether the future benefits are increased or not, or you can benefit in future or not, you should expense it. Okay, so in summarize, we capitalize, we record, or we put them become a part of the asset cost, right? Assets value, park on the balance sheet. We can only capitalize those expenditure that benefit a future period and all those and exceeds the materiality of the expenditures, right? After we met those two criteria, then you can park on the balance sheet as a part of the capital. But we please remember, we expenses items that benefit only for the current period. So when we do the like in class exercise, I want you to see that when you look at the questions, then this gonna benefit for future period, this is not gonna benefit for future period or only current period, then that's the key I say is the eye of the question for you to get a hint of whether you should expense or capitalize it. Okay, so let's check this concept. Which of following costs should be expensed? Adding a refrigeration unit to a delivery truck. B, adding a new suspension system to delivery truck that will allow heavier load. That's what we call improvement, right? So we will capitalize it. Adding a new transmission to a delivery truck that will increase the life and future benefits. Okay, this is definitely capitalized, right? And performing a tune-up on a delivery truck. I choose D because tune-up should be very easy and low cost and also periodically. And adding a refrigeration unit, that's definitely can benefit in future period because that refrigerator can serve the truck for more than one period. And this should be the D, right? Tune-up are necessary to maintain the truck and are regularly required, hence the cost of the tune-up should be expensed. All the other items should benefit in the future period and need to be capitalized. Okay, so for the length of the video, I wanted to stop here and then I will do the cost allocation in another video, okay? And I see you next video. Thank you.